So we'll talk about Chapter 8. Chapter 8 is about making investment decisions. Any investment problem has usually an upfront cash flow that you have to expend. You buy a machinery, for example, or buy a factory. And then in subsequent years, you're expecting to generate multiple cash flows going forward. Positive cash flows, hopefully, most of them. In a situation like this, the fundamental question that arises is, should you make that investment upfront? And that's a common question that companies face almost on a daily basis. They have multiple decisions to make, from small investments of acquiring computers or buildings to large investments of acquiring another company, mergers, and so on and so forth. So the decision rules that we learn over here can be applied to a variety of contexts. Not only on context when you have an upfront investment, followed by many subsequent positive cash flows, but where you also have a situation where it may be that you are collecting money up front. Let's say you are selling tickets to a sporting event, you are collecting money up front, and then you are going to be subsequently spending that money when the event is actually on. In other words, the cash flow situation may be reversed. So we can see all of these situations. The fundamental question that arises, should you undertake a project like this? Whenever we are talking about investment decisions, we are essentially talking about what we label as projects, which is a very generic term for any investment opportunity. And almost any decision that the company makes that requires expenditure of money can be labeled under this rubric of projects. So what we're going to learn over here are the basic toolkits that we will be using in order to make a proper scientific decision regarding investment opportunities. So when we are looking at these decision-making processes, the fundamental rule that we always use anytime we have to make an investment decision is we compare benefits with costs. And if benefits exceed cost, then we accept the decision. That's the general rule. You don't need any scientific methodology, you don't need any degree in economics or finance to make that decision. Any person who's engaged in any monetary transaction would be essentially making this kind of evaluation. What we have to place into scientific context is when we have a situation where the cash flows are spread across time. So here you have your cost and your benefits are in the future, which is the most typical investment opportunity. In a situation like this, I just cannot add up these benefits and subtract them or subtract costs from them. Because these benefits are at future time period, I have to convert them into present value terms. And only after conversion into present value terms would I be able to make an appropriate decision. So we are going to look into this type of methodology, and we are going to look at all of the different possibilities that we have when we are looking at these types of investment decision making. I'm going to quickly just set up the calculator over here so that we can bring it up when we need to work on some of the problems. Okay. So we're going to look at the decision rules. So whenever we are making an investment decision, our goal would be to select investment decisions that have the highest NPV, where NPV is defined as the difference between the present value of benefits minus the present value of costs. So if we are ranking among different investment choices, then we will rank them from the highest to the lowest, and of course, choose the one that's the highest, provided we are dealing with mutually exclusive projects, meaning projects that we can only choose one among many alternatives. If we are in a situation where we can choose multiple projects, for example, I can build a building as well as buy a computer system. Then if both of them have positive net present value, I can accept both of them. However, if I'm choosing among different vendors to set up my computer systems, then I will choose the one that has the highest net present value. And the logic for choosing net present value as the method for evaluating our investment decision is very simple. It goes back to the very first lecture in finance, where we talked about that the fundamental purpose, the main purpose of financial management is to maximize shareholder value. And we believe that the net present value method achieves that goal of maximization of shareholder value, because we are looking at value in present value terms. In present terms, we are looking at value. And the computation of present value takes into account the riskiness of the cash flow. Because obviously, whenever you are projecting things into the future, you do not know exactly if those projections, these forecasts, will be realized, meaning there is some risk associated with those projections. And so to properly account for that risk, I am going to be able to take the present value of these future cash flows by considering what is my appropriate discount rate. So that process, that simple process of taking present value, not only allows us to capture value, but captures value in the context of the riskiness of future cash flows. Okay, so here is a simple example. You have $500 today. You are expecting to receive $550 a year from now. Interest rate is 8%. Do you accept this proposition? And the answer would depend upon, so you could put it in a timeline. You have an investment of $500. A year from now, you are expecting to receive $550. The interest rate over that time period is 8%. Should you accept the project? In your time value processes, you would say future value, time value computations, you would say future value 550, present value minus 500, IY equals 8, and you will compute present value. And that present value would be 9.26. It's positive, so you accept the project. Meaning, by accepting this project, you have added $9.26 in value. Okay. So the simple rule, anytime net present value is positive, we accept it. If net present value is negative, we reject it. If net present value is 0, we're indifferent about it. We may accept it, we may reject it, depending upon any other considerations. Okay, you can work through some of these examples on your own. Just gives you multiple examples to work on your slides or review them, just to be able to see different computations and different examples of it. So here is a project. Now we go from a one-period cash flow to multiple period cash flow. So we are looking at a factory that will be built at $81.6 million. So that's an expenditure that will be spent now. So that becomes our cash flow, C0. and it will have a return of 28 million per year over the next 4 years. So we can transfer that into a timeline. This is our investment, C0. These are our future cash flows. So this is C01, C02, and so on and so forth, until the last year of the project, should we make this investment. The simple way in which we can do this, would be, we take it to our financial calculator, clear everything, second clear TBM, cash flow, second clear work. So we are going to enter 81.6 negative as 81.6 negative, enter, that's our cash flow 0, down arrow, C01 is 28, enter, down arrow, and since that $28 million cash flow repeats 4 times, so F01 would be 4, enter. Now we've entered all our cash flows. Then we go to net present value, and what we had for our interest rate over here. Our interest rate was 10%. So interest rate is 10%. Enter. Then we take down arrow and compute. And we get 7.1562. So that's the net present value. Net present value is positive. And that's what we see over here, that the company had a positive net present value. $7.2 million net present value, so we accept the project. It's pretty simple, straightforward way of decision making. Now, what we see in this example also is that the net present value is not only dependent on cash flow, but it is also dependent on the cost of capital. What is this cost of capital? This cost of capital is the rate at which we are discounting our future cash flows. So this cost of capital reflects then the amount of money that I as a company I'm spending to receive this capital from either shareholders or from bondholders. In other words, money is not free. The capital that the company is utilizing, either from its own coffers or from external sources, has a cost to it. So for every dollar that the company raises, we assume that the cost was 10 cents per dollar. That's how we got a discount rate of 10%. That means for every dollar that the company borrows, let's say, to invest in this project, they will be spending 10 cents. And what we found is that despite that spending of 10 cents, the company would still generate a value of 7.2 million, despite spending this 10 cents per dollar on their capital. And that's why we accepted the project, because we are adding value to the company. But what we also want to note is that we were here. This was our starting point. When discount rate was 10%, we had a net present value of 7.2, which we can put it on this graph, 10%, 7.2. So we can, if we are plotting discount rate R on the x-axis, and we are plotting net present value on the y-axis, then we go to this 10% number, go up to 7.2, and we can put this as one of the plot points. Then what do? We can go back to our calculator we can go back to our calculator and we can change the discount rate. So I can go back over here. I can go back over here to 10%, and let's say I want to decrease my interest rates to 8%. 8, enter. I go down, I compute. It's 11.1. That's what we see here. When discount rate is 8%, that's 11.1. I want to go back and I want to increase discount rate to 12%. Net present value, compute. Net present value goes down to 3.4. I begin to see a pattern. I begin to see a pattern that as discount rate increases, net present value decreases. Right? Net present value is decreasing as we are increasing our discount rate. So as discount rate increases, net present value is decreasing. So the NPV profile, this blue line, which is now red, I just wrote over it, is downward sloping. So when interest rate was 8%, this was 11.1. When interest rate was 12%, this was 3.4. And then we get to this point, which is an interesting point, where we see that if the interest rate increases beyond that 14%, net present value becomes negative. Right? So this point represents my crossover from positive net present value territory to negative net present value territory. And we call that the internal rate of return. We give this discount rate a special name. This is the rate of return at which net present value is negative. So if I go back to this formula over here, and I want to do this, I want to set net present value to 0, and I want to calculate R, this R would solve to 14%. You can try this on your own. Substitute 0.14 here, substitute 0.14 here, and do the math, and this whole thing would equal 0. That's what IRR stands for. It's the discount rate at which net present value is 0. So we give it a special name. Internal rate of return. Okay. So those are the two major rules that we use in trying to do capital budgeting. So to do IRR method, the way we will do IRR method would be the following. We go back over here. I want to go back to that 10% baseline. Enter. Compute. We had 7.2, 7.15, whatever. If I want to use the same numbers that we used earlier, 81.6 as investment, 28 million as future cash flows for the next 4 years, so not changing the cash flow, and I simply want to calculate IRR. I will go to the IRR key, which is next to the NPV key, and then hit compute. And I get it's 13.99 or 14%, approximately 14%. So that's how I calculate IRR. And that gives me my two methods, two basic methods, the net present value method and the IRR method. And if you look at CFOs and you ask them which methods do they prefer to make their investment decision, it is always one or the other, net present value and IRR. The question then becomes, if net present value and IRR always agrees, then it really does not matter which method we use. But what if they disagree with each other? What if net present value rule tells me to accept something while IRR rule tells me to reject it? How would I then reconcile if those situations happen? In other words, when should I use which method to make decision? Before we go on, I also want to address a little bit about the payback rule, which is not the strongest rule and not as commonly used. Although, as you can see from the slide over here, it is not uncommon either. It's not the most common method, but it's not uncommon either. So that means There is some usage of this method, and perhaps we need to learn then when we should use it and when we should not use it. First, what does the rule do? The rule is a very simple rule. It is the simplest decision-making rule on investment. You're simply asking the question, how long does it take, the amount of time it takes to pay back the initial investment, without any consideration of when that investment is being paid back, without any consideration for time value. So for example, you look at a situation like this, you see that the company has invested $10,000 and is expecting to make $1,000, $1,000, and $12,000 in the future years. And you can ask the question, what's the payback period? How many years would it take for me to recover this money? So as you can see, in the first year, you recover $1,000, and you recover $1,000. That means you have $9,000 left to recover. In the next year, you recover $1,000 again. That means you have $8,000 left to recover. And in the last year, you recovered $12,000. You had $8,000 left, but you recovered $12,000. So that means you have gone past the amount of money that you needed to recover from your initial investment. So in this year, you had left $8,000 to recover, but you recovered $12,000. So definitely you know that between year 2 and year 3, you recovered your money. So it will be 2 years plus the $8,000 that you had left in the third year as a percentage of the total amount that you recovered the third year. So that would be, if you, 4, 2, and 3. So 2/3. So it will be approximately 2.66 years. Is that an acceptable number for you to use to decide whether to accept this project or not accept this project? We don't know that. Is 2.66 acceptable? Is 3.66 too much? We don't know that. There is no specific way in which you can say, well, this is acceptable and this is unacceptable. The only way you can make that decision is to put it in the context of your company or your project. So for example, if 2 projects have the same net present value, there are 2 mutually exclusive projects, you can only select one of the 2 projects, and both of them have the same net present value, then what would be the tiebreaker? One of the ways in which you could break the tie is to look at payback period. Obviously, you want to select the project that has the quickest payback period. You want to recover your investment as quickly as possible. So the advantage of this rule is it's simple. The disadvantage of this rule is that it does not take into account that $12,000 is coming in year 3, not in year 1 or year 2. So it is placing equal weights on these 3 cash flows. It is disregarding the timing of these cash flows. Another problem you can look over here, and this one probably illustrates the challenge of the payback period. You have to recover $10,000, and you can see that, of course, you will recover it somewhere between year 3 and year 4. But in year 4, you are making $1 million. That does not add any more weight to your project. It simply tells you, well, you recovered the money year 3, year 4, between year 3 and year 4, without telling you that in year 4, you are going to make a windfall, a cash flow. So the payback period does not discount future cash flows. And of course, this is a mistake. This is a fallacy, as we have heard in time value of money, that anytime you have cash flows occurring in the future, you have to convert them into present value. Nonetheless, despite this mistake, despite this fallacy in the system, we still rely on it. We still rely on this system, partly because it's a simple system. It's a simple method. So over here, if you look at, you have two projects. Both have the same investment. Their future cash flows, as you can see, are given over here. Which project would you choose? Project A would take you 3 years to recover, right? Then 1,000, 1,000, then in the final year, you recover the remaining 8,000. Project B would take you 2 years to recover. So is Project B superior to Project A? If you only relied on payback, you would make that conclusion. Project B is superior to Project A. But if you put them in net present value terms, obviously Project A would come out to be superior because it has this tremendous cash flow happening at the end of the 4th year. So it again illustrates for you the fallacy of the payback rule, and nonetheless it is still used. Okay. We looked at IRR and net present value, but I want to quickly review any weakness in the IRR. So between net present value and IRR, if everything else is the same, I would generally prefer NPV over IRR. If it is a normal project, having the normal characteristics of an upfront investment followed by multiple cash flows in the future, I would always select net present value over IRR. However, the question is why? Why is net present value a superior method over IRR? And that goes to the heart of this situation, and I'll illustrate this using a simple timeline, a 2-period timeline. So assume we have an investment of, let's say, $1,000. And we are going to be making money in the future, next 2 years, of let's say $800 and $800. Simple problem. Should we do this project? Well, the answer to this will depend upon what's my rate of return? What's my R? And let's assume the R is 10% both years. And I can go to my calculator, clear, go to cash flow, second clear work, cash flow. Okay, so I'm going to enter 1,000, negative, enter, down arrow, C01 would be 800, enter, F01 would be 2, enter, I'm done with my cash flows. I go to net present value, 10, enter, down arrow, compute. Gives me 388, I should do this project. And so I got net present value of 388. What does that 388 then mean? That 388 means that I am adding approximately $388 of value to my company by accepting this project. But the fundamental question that's often not raised, but it has to be acknowledged, is what are we doing with these cash flows? When we incur these future cash flows, what do we do with them? In a real-world situation, what does a company do when it recovers, when it makes money in the future? What does it do with that money? The assumption is that this money is reinvested in the company. And it is reinvested at the prevailing rate of return, at the prevailing cost of capital, at the prevailing required rate of return. Because anytime the company reinvests money into its own business, it has to generate a rate of return that its investors are demanding. That means our assumption is that these future cash flows are being reinvested at the 10% rate of return. And the net present value method, when we calculate the net present value, what are we doing? We are subtracting 1,000 plus 800 divided by 1 plus 0.1 plus 800 divided by 1 plus 0.1 squared. So in the net present value method, we are discounting the cash flows at this assumed rate of reinvestment. So the methodology of net present value matches with the realism in the project. And it is for this reason net present value is a superior method. However, when we are doing IRR, if you recall, what did we do for IRR? We said 1,000 plus 800 divided by 1 plus IRR, 800, 1 plus IRR squared, and we set this equation to equal 0, and then we solved for IRR. So what does that IRR represent? That IRR represents the reinvestment, the assumed reinvestment of these 800. So in the net present value method, my reinvestment rate is the actual rate at which the company is reinvesting. In the IRR method, this number is different from this number. So if I go back to my calculator and I go to IRR and I compute this IRR is 37.97. The IRR method is assuming that these two $800 cash flows were invested at 37.9, when in reality they were reinvested at 10%. So there is a mismatch between what the company is actually reinvesting their money at and what the two methods are assuming. The net present value method comes closest to what the company is doing. The IRR method does not. It is for this reason that we select net present value as the superior method of investing. This holds true if the projects are what we call standalone projects, meaning that we are evaluating each project one at a time. And all of the negative cash flows occur before positive cash flows. Negative cash flows up front, followed by positive cash flows in the future. Then the net present value and the IRR method will both point in the same direction. However, if these conditions are not met, there may be disagreements between IRR and net present value, as we will see over here. One of those is when we have delayed investments. So in this situation, we have a payment of $1 million upfront, followed by expenditures of $500,000 for the next 3 years. What would be the IRR for this method? So it's a simple process. We go to our calculator. This is our C0. Note now C0 is plus, and C01 would be negative 500,000, negative, and F01 would be 3. And I can solve for IRR, it will come to 23.38. So we can solve IRR in this method. If So this 23.38 is greater than the 10% opportunity cost of capital. So of course, we approve the project. Now if we put this into net present value terms, plus, minus, we get net present value is negative. So IRR says accept the project, net present value says reject the project. So how do we resolve this conflict? Well, we redraw the net present value profile like we did before, where we change the different discount rates and we calculate net present value under these changing discount rates. Note, in the previous instance, our net present value profile was like this. As we increased discount rate, net present value went down. That was when we had the normal situation of upfront investment followed by positive cash flows in the future. Now we have an opposite. The upfront cash flows followed by investments in the future. The net present value profile is reversed. Now it is not downward sloping, it is upward sloping. So when the cost of capital was 10%, net present value was negative. However, IRR is greater than cost of capital. So because of this reversal in cash flow, I would select IRR as my decision-making rule, not net present value. A similar situation can happen when you have upfront investment, upfront positive cash flow, followed by years of negative cash flow, and then a cash flow reversal in the last year or in a subsequent year. In other words, we went from positive cash flows to negative cash flows to positive cash flows. If I do a net present value on this, if I do a net present value profile on this, we will see that we will have multiple IRRs. At a cost of capital of 10%, we would have a negative net present value. Net present value will tell us not to do it. IRR method will give us a conflicting result. There are two IRRs because net present value profile is neither this nor this. It's this weird U shape. It intersects the x-axis at 2 points, giving us two net present value, two IRRs. So in this case, if I have multiple IRRs, then I would select the net present value as my decision-making variable. I'm going to be skipping the modified IRR method. You can review through this one, different decision-making rule. Again, applying the net present value rules for mutually exclusive projects, something we just covered, but gives a little bit more examples over here. Over here, the interesting difference is that we have three different projects with three different investments. All of them have different cash flows and different rates of growth. So over here, what we're assuming is that these cash flows grow into perpetuity. So our net present value would be the negative initial investment, negative C0. But this future present value is simply the present value of a perpetuity. And we can calculate that and we can see that they have three different net present values. In this situation, what should we do? It's a mutually exclusive project, so we select the one with the highest net present value. So we get present value of a perpetuity, which we know is C1 divided by R minus G, the cash flow next year, growing at a constant rate forever. We subtract that from the initial investment. We subtract the initial investment from that, and then we calculate our net present values. Okay, so you can review through some of these other examples just to give you a little bit of more practice. So let's end the first part of the lecture here, and we'll come back and review the second part.